Hello, everybody. Welcome. Thanks for joining on this industrial masterclass. Very excited for you to be here with us today and got a lot of things we're going to cover today. So if you've heard of investing in industrial real estate, you've done it before and you're curious on what does it mean? What does it look like? How does it compare to other real estate investments? And what does the landscape look like right now? We're going to dive into all that and a lot more. And today brought in our good friend, Brent Peterson. Brent is a industry expert. He's been in the industrial real estate space for several decades. He's a broker, an agent, an owner, and really understands all the dynamics going on. And so we actually had him on a couple of years ago. So really wanted to get kind of an update from him. So we're going to dive into all the things I just shared. What's happening in the landscape? How is it shifting since COVID has happened? What's really going on in the capital markets? How is that impacting opportunities? And then really, where is he seeing the biggest opportunities? Where are the big institutions kind of gearing up and getting ready to make investments in this space? So why are we at the beginning of potential new boom in industrial real estate? All that and more we're going to cover. So you want to tune in, stay to the end. There's a lot of information. And we at the very end are going to have a Q&A. So with that, let's go. Hello, everyone. Welcome to this industrial asset class deep dive. Call it a masterclass on industrial. It's kind of a fancy term, but basically we're going to be talking all about industrial real estate today. And if you've been following us for a while, you know it's an asset class we really believe in. We're very excited about, and especially in this environment where things have kind of changed a lot over the past really year and a half, has a lot in commercial real estate. Mm-hmm. We actually think it's presenting a lot of opportunities in the market. And so we're doing a masterclass today. We've brought on one of our favorite people in the space, Brent Peterson. Actually done several deals together, and this is your bailiwick. This is what you've been doing for a long time, been in industrial real estate for a long time. And so wanted to bring him on. Actually had him on, when was it? Probably a year ago?
Probably just over a year ago.
Okay. And thought, hey, it's a good time to bring him back on because we have a lot of things happening in the market and want to get people just seeing what's going on. Because I think there's a lot of questions, a lot of people have seen, especially in the multifamily sector, where there's been a lot of just challenges in the short term. But industrial is a little bit of a different animal. And so a lot of people haven't invested in this asset class. We wanted to kind of help them understand what the drivers are. But for those that aren't familiar with you, haven't maybe watched the last time we did an episode, share a little bit on your background, what you do, and kind of how you work in this industrial space.
Sure. Well, appreciate the intro, and it's good to be on again. So I've been in Kansas City for 27 years. Went to school in Nebraska at Creighton, got an accounting degree, and spent a little time working for one of the big six firms at the time, KPMG, Pete Marwick, on their audit side. And that just wasn't a fit for me. And anyway, spent a few years in doing construction and modular and manufactured homes, and did some development. Learned a lot about finance, learned a lot about construction, and it was a great way to learn about managing people. And in the meantime, I got into buying and selling a little bit of real estate and really enjoyed commercial real estate. And about 20 years ago, I made it my sole endeavor. So I've been doing industrial and investment sales for the last 20 years, and work for a shop here in town called NAI Heartland. We're an international firm with local offices, and I joined them about a year ago as a partner with the firm, and was at my previous shop for about 10 years prior to that, but have really enjoyed it. And been a lot of interesting things have happened over the last 20 years in commercial real estate. The size of the product, the investment appetite for the product, and the proliferation of building across the country has been amazing to watch and be a part of. So it's been fun.
So you pretty much exclusively focus on industrial, is that right?
Yes. Occasionally I will stray out of that discipline if I have a good client that is invested in a different type of asset class. But I typically bring somebody on that is an expert in that asset class, and I'll go along for the ride. So I learn a little bit about multifamily, retail, office, but I'm never the main driver when that happens. And I do focus all of my attention on industrial, though.
Got it. So talk a little bit about just the evolution of the industrial real estate sector, right? So a lot of people that are, investing in commercial real estate, most people are investing in multifamily apartments. It's kind of been the bread and butter for a lot of people. And you've heard of industrial, I've heard of a triple net lease investing, other types of things. But, what's really made this a pretty sophisticated asset class, a lot of capital that's seeking to get into it. And e-commerce has been a big trend. So talk a little bit about what's kind of driven this asset class to where it is now, and what's kind of taken it to the next level.
Those good questions, and I'm probably going to repeat some of the stuff that I've mentioned on our previous podcast. But I think the biggest thing that has changed the industrial market is the amount of speculative industrial development that has happened. Kansas City, Wichita, across the Midwest, and across the entire United States. People found out that if you build it, they will come. And, Kansas City is a prime example. Kansas City did not have a lot of speculative industrial development until about 2008 or 2009. And, one guy took a shot at it, built a great big industrial building and had no tenants for it, and got it leased up pretty quickly. And other people took note, and they said, hey, this actually works. And, it was working prior to that in other markets, East and West Coast, and some down in the South, where, you had bigger population bases, and more of a need. But like Kansas City, Wichita, other Midwest markets, they said, we have a need here as well. And because of the strategic location of a Kansas City or Wichita, you've got great highway access. You're right off of I-35, which is the main north-south thoroughfare that, cuts through the United States. It makes a whole lot of sense to have a distribution facility in this market, or multiple distribution facilities in this market. So guys said, you know what? I can build a product. I can build a product with certain clear height, certain number of dock doors, certain, decent column spacing. And there's a high likelihood that I'm going to get a user that will come in and take that space and lease it if I just build it. So it took one person to take the gamble, and it was proven successful in this market, and we were off to the races. So again, Kansas City wasn't, build it and they will come until about 2008, and it's changed. So that happened prior to COVID. I think what happened,
it probably benefited from the big boom in e-commerce, right? So at the same time, we saw a huge growth in e-commerce, which was driving distribution needs. So now the Amazons of the world are trying to get their product to the end user, and so they want to have closer access points to where the populations are, at least to the highway systems to get to the population. And that's continued to be a driver. Is that still the main driver right now, or what's kind of driving demand right now?
Yeah, good point. Yeah, people don't go to stores for most of their purchases now, or a lot of purchases at least. I mean, it's so easy to go shop online and have it show up at your door, and people want it right now. I mean, if you order it, next day delivery is not unheard of, and you almost come to expect it. So I would answer you with saying, yes, that is driving some of the continued growth in industrial real estate. But I think there's also some reshoring that's occurring. I think COVID did a couple of things. One, it said we need to have better distribution routes and more distribution locations to serve our customers. Maybe we have a spot in Kansas City. Maybe we have some place over in Virginia. We have something on the West Coast in California, and maybe someplace north and south, rather than just one distribution location that, takes us 4 days to get our product to the end user. So that's continued to happen. And whether that's, an Amazon or, some big e-commerce giant like that, or whether it's just a 3PL, a third-party logistics provider that is working for a client that needs to get product out the door quickly. And again, I think COVID really drove home the point that we need to reshore some of the manufacturing that we were allowing to go overseas. The CHIPS program, I forget the dollar amount. I think it's $400 billion of incentives for development through the CHIPS and the Inflation Reduction Act are being put into play here in the U.S. economy.
So talk about with the CHIPS Act. I've probably haven't heard that, right? And it's a big deal.
Basically, the U.S. is saying we don't want to be reliant on foreign countries to provide the microchips that run so many of the electronic devices that we have in our world.
Yeah.
And they said, we need to create more of that here in the United States. We also can control how much we get, when we get it, and the quality of the product as well. So it's driving jobs here in the U.S. I mean, there's, as you may have talked, there's a proposal for a large facility to be built down in Wichita, close to one of our next projects that we're working on down there. So it's happening here at home, and it's happening across the United States too. Yeah. And same thing with batteries as well. Like Panasonic is building a huge facility on the west side of Kansas City here. It's going to employ 4,000 people. It's
basically build batteries, right?
They're going to build batteries. Yeah. And,
we need a lot more of, given all the goals of, all the electric vehicles and other green energy goals.
Absolutely. And I mean, and it's good for the economy when that happens too. So I think people take note of that. So it's not just chips, it's not just batteries, but we're trying to bring a lot of the core products that we need to drive our daily lives back to the U.S. And I think we're going to continue to see that as well. So
I mean, it's interesting. We've talked a lot about it in previous, episodes over the past few years on the reshoring trend and how kind of big of a deal this is, because it's kind of fundamentally rewriting these big decisions that these companies are making. And for so long, when I was in school, and it was all just in time, it was all export jobs. It was, create the maximum amount of efficiencies by creating a good supply chain. And the goal is just to minimize, tangible costs. But COVID really put a pretty big wrench into that, showing there's a lot of intangible costs that, political risks, obviously delivery risk, and, shutting down economies and all the things that you couldn't really quantify, but then became very impactful to the bottom line. I remember reading some of the headlines with Ford, the auto manufacturer. At one point, they had billions of dollars of inventory in completed trucks sitting on lots that they could not sell because they didn't have these computer chips.
Correct.
It was one of the huge bottlenecks in manufacturing for a long time, and still is a big, challenge to hit some of these, deadlines. And what's the cost for Ford to say, hey, well, for certain critical components of our manufacturing process, we're willing to maybe pay a little bit more to have control over when we can, complete the construction or complete the fulfillment of this part of the process, so that you're not relying on, somewhere overseas that you can't control what's going on over there.
Great point. Yeah. Automobiles, because they require so many parts to make, are easy to choose and say, all right, if we can build the vehicle here and then ship directly from the United States, we don't have the lag time. We have the product here and under our control to some degree. You're still reliant on those suppliers to provide those parts. But when you bring the batteries and manufacturing here, when you bring the chips manufacturing here, or the bumpers or the tires or the lugs or whatever it might be, all those different components that go into making that vehicle and bring it back home, you can control the quality a lot better. You can have more of it at your disposal more quickly. And then you can get a finished product out that you're, when you're going to get it and what it's going to cost you as well. So that's right. That's what we're seeing. And we're seeing it not just in automobiles, but in aviation and in all kinds of consumer products. So those are just the easy ones to cherry pick because they're such huge projects to look at and point your finger at. So
big number. I mean, some of the stats we've seen on some of the reshoring initiatives and the capital spent to bring the manufacturing back or inventory back and other things, tertiary industries around that. I think $1 trillion was spent last year just in reshoring, and it's likely going to be early innings because we're just seeing the rewriting of how these are working, right? So it's shifting a lot of perspective from these companies of, how do we want to build our supply chain? How do we want to reconfigure manufacturing? And hey, let's actually look at the numbers again, because it's a lot less expensive comparatively to 15 years ago to manufacture in the U.S. than it was, in China.
Yes.
Back then, it's not that much more anymore. And not only do you stimulate the economy and the growth, you have more control and other factors that are very valuable.
Sure. And people like to buy American, and it's easy to sell, American-made product too. So it's no doubt. The amazing thing about this is we've seen this continued growth in industrial manufacturing and distribution even when interest rates have continued to tick up and make deals more difficult to get done. So it shows you that there's a real need and that people are trying to find a way to make it work. So
yeah, I mean, we're seeing that real time, right? We've completed some projects, and
absolutely,
it's leasing is maybe a tiny bit slower, but demand is still there, and it's just a matter of how do we strike a deal here, because we have a space we need to move into, and it hasn't impacted a whole lot as other asset classes.
Yeah, you're right. We've seen slowdown in leasing without a doubt across the industrial sector, but it still is happening out there. But people are being more diligent about the process, and it does seem like deals are slower to happen. And again, I think that has to do with an election year. There's a little bit of uncertainty with the economy. I mean, I think with that, assuming we get some type of a rate reduction, if the Fed does lower rates, even a small amount, I think we're going to see a very positive movement from the economy out there. So, yeah, it's good. The interesting side of that, though, is the investment side of sales on these big industrial projects has really just slowed down, and it's because guys that have the product and they've got long-term financing locked in, and they may have done this deals locked in. Long-term debt, and they're looking at their exit cap rate and they're saying, it just doesn't make sense. It makes a whole lot more sense for me just to hang on to this, see what's going to happen in a couple of years, and then look to sell it. So it's made the investment side of sales, slow down quite a bit across the entire countries.
So obviously we had a big boom in e-commerce. We've had kind of a more recent boom in reshoring. And is the type of product that users or tenants are looking for different than what it was 10 years ago, or is it largely the same, but the mix is a little bit different? Maybe there's less distributors and more manufacturers, because obviously there's still growth in e-commerce. It's not as fast of a rate of growth as it has been in the past. What are you kind of seeing from a mix standpoint? Is it changing a little bit from what it was before?
I would say from 10 years ago that we are seeing more manufacturing buildings and construction going on. As far as the distribution side of things, I think the product has changed a little bit. I mean, it started smaller, it became big, and we had a lot of groups looking for these huge bombers, 500,000 to 1 million square feet. And, that market has slowed down quite a bit actually over the last 12 to 18 months.
Right.
So we Kansas City's got a few million plus square foot buildings sitting on the market. So I'm sure that gives some angst to some of the, guys that have built those larger buildings, but the smaller product in that 100 to 300,000 square foot range has continued to do extremely well in this market and, across the country as well. So I think companies that are looking for new locations have maybe said, I can downsize a little bit and still make it work. And I don't need 1 million square feet to house this operation. Or even if they feel like they may need that, they put that on hold for the current time. So, yeah,
some of the data I've seen recently is if you bifurcate the vacancy in the market by size of the building, if you kind of take out the 500,000 square feet and above from the sample you're looking at, it's less than, I think, 4% vacancy across the entire market for the properties in that 100 to 200,000 square foot availability. I mean, which is pretty much functionally,
I mean, that's a great story to tell. And it gives you a reason to say you should continue to build product.
Yeah.
I was going to tell you some stats. Kansas City, let's see, we've got about 12 million square feet under construction right now. Most of that is already spoken for. You've got the Meta data center that is up by the airport. That's 1 million square feet. You've got Panasonic that's 4 to 5 million square feet. And you've got the Ace Hardware, which is 1.5 million square feet, all under construction right now. So you've got close to 7.5 million square feet that is already spoken for just in those 3 buildings, not to mention some of the other build-to-suits that are going out there. And, the deals in that 100 to 300,000 square foot range, there's very few speculative construction that's going up right now that isn't spoken for. Something like 60% of those or 65% are already leased in this market. So,
wow.
Another thing though is as interest rates have gone up, we've seen a lot of the large, nationwide developers really slow down, and they haven't completely put their pencils down on new construction. but they have been very selective about what they've built and where they've built it. And they'll continue to do build-to-suits, but we're not seeing nearly as much speculative construction now as we did 18 months ago. So it's kind of like carry forward with the projects we had, but we don't need to push it to try to, just keep the, keep the machine working. So they've hit pause or at least slow down on some of the projects out there for sure.
Yeah, I mean, it's a pretty similar story we're seeing in multifamily as well, where there's a huge construction boom a couple of years ago. And when you had the cheap financing, demand was just rip roaring, economy's on fire, everyone's just building anything they could do. And a lot of that product has hit the market or is going to be hitting the market this year, beginning of next year. But the starts have really fallen off a cliff, which is the new projects that are being started. At least you're saying the speculative ones. So there's build-to-suits that are happening all the time that are basically building this building for a specific user, and it's already agreed upon before you even start.
Absolutely.
But there, a lot of times, like the developers are not going to go build a build-to-suit for a smaller user because the numbers don't work as well.
That's right.
And it's a lot of big numbers. In a lot of the bigger developers are just wanting to pull back because, they have these bigger properties that are sitting vacant, and, it's more difficult to get deals done because financing is way more expensive. Capital is hard to find, but now might be the best time to be starting projects because by the time you're completing them, you're bringing them to market, there's not going to be much competition. Both, likely what's been in the market is not absorbed yet. Most projections are that absorption is going to, or demand is going to absorb all the remaining product over the next 18, or so months. And now you have no competition from other new product that you're competing against, and you might be the only girl at the dance that you have the product for.
That's exactly right. I've talked to 3 of those larger developers that build nationwide, and all 3 of them have said right now is probably the time where we should be building even more product, or we should still be, churning away because there's some real opportunity. The guys that are doing it are probably going to see the benefits from it. So it is a little scarier though, because financing is tougher.
Yeah.
And, the exit strategy is a little bit uncertain right now. I mean, you may have to hold that product for longer because you may not want to dispose of it once you've got at least, at the cap rate that you can today. But you mentioned, multifamily and comparing it to industrial. And I think those two are very similar in a lot of ways. And the reason I say that is they've almost become a commodity to some degree.
Yeah.
Because you can really monetize, okay, what is my true NOI on that asset? I can put my own management group in. I may be able to nuance the numbers a little bit by either improving the efficiencies of how I manage it, or I may be able to boost the actual occupancy rate within that building. But I know roughly what I can make in multifamily if I buy this asset and I just continue to let rates go up a little bit. Industrial is not much different.
Yeah.
You're building so many of these buildings to similar size, specifications, highway access. I mean, it's a pretty simple template of what you need to do in order to meet the demand out there. And if you just build that, whether a buyer's looking at an industrial building that's an investment type of industrial building in Indianapolis or Kansas City or Chicago or LA or wherever, they can look at that market and they say, all right, I know what my NOI is. I can give it maybe a little plus or a little minus based upon the location, but here's my strike price for that asset. So I think it's real similar to what you'd find in multifamily too.
Yeah,
so
absolutely.
Just a numbers game, really,
Talk a little bit about, as the demand is shifting a little bit, the use case may be a little bit different. If reshoring, if manufacturing has become a bigger component of the U.S. economy again, how does that change some of the shifting from a broader perspective of where the big industrial hotbeds are? Historically, it's mostly been coastal because of all the imports that we would do. And it's not necessarily going to go away, but it seems to be shifting a little bit more to the nearshoring, like Mexico and the other trade relationships we have, and more Midwest that are now a lot of users are wanting the ability to be close to most major markets in a certain distance to where you have access, right? So talk about how maybe perspective has shifted a little bit on where a lot of the new opportunities are relative to the kind of old world of the big coastal gateway markets.
Sure. Well, the manufacturers, have more than just distribution in mind when they look at a specific location. They're focused heavily on workforce a lot of times, and maybe workforce incentives. So, cost of that labor, quality of that labor, the education level, the unemployment rate is really, really critical to those folks. And then they will, obviously factor in, can I get my product from this small town America, if that's where the best labor market is, to all of my end users in an efficient manner? And they'll do that equation as well. But I think, by and large, I think there's probably more readily available labor in the South that will attract or continue to attract more manufacturing companies as they're considering the U.S. I think Mexico is going to continue to be a huge provider of product to the United States. I mean, I think it's overtaken China as the major importer to the U.S., and I think we're only going to continue to see that grow as time goes on. I was at a convention 3 or 4 months ago and met with another broker down in Laredo, Texas, and I was astounded by the fact of how much product comes through that market and how busy their distribution hubs are in that location. And it's because it's an easy corridor to get from, Mexico to the United States and distribute from there. So again, I think we're going to continue to see a lot of development in the southern part of the United States. Also, the weather's more conducive to working all year round. You don't have sick days. You don't have the cold that you have to fight.
Right. Yeah.
People, I think, would rather deal with the heat than, 2 feet of snow on their roof and roads frozen up where they can't get product out. So I think those manufacturers are going to look for markets like that and factor all those little items that matter to them into that equation and then continue to make decisions on where they want to be. But I would look heavily in the southern part of the United States if I were trying to, bet on that. So,
yeah, I mean, it seems like a different calculus that users are using to determine location, right? Where historically, if it's just an import market and you're just trying to distribute as quickly and as far as you can, the coastal markets make sense. But now, if you're a manufacturer and your biggest cost, aside from maybe the product itself or the raw materials, is your labor, right? And so you want a place where, like you said, you have good workforce, but also reasonable pay. And, if you go to the coastal markets, those are the most expensive markets. So you're going to pay a lot more. Mm-hmm. And if you have a good workforce with more of a blue collar workforce, plus the ability to have good distribution access, that's kind of the sweet spot, right? Where a lot of these people users are looking at that as a core part of it. Absolutely.
There's no doubt. And it's interesting to be on the tours with those manufacturers to hear them talk about things that you don't hear from the same guys that are distribution users for a building. So they have a lot more questions for the local economic development folks, a lot more questions for people in politics there, because it matters a lot to them because that workforce is so critical to what they do. So
yeah. Let's shift a little bit to just bigger picture. What are you seeing in the market, right? So you've been in this asset class for a long time. You've seen, ups and downs in different parts of the cycle. What are you seeing? We've kind of hit on a little bit here, there on absorption. We've hit the bigger spaces are sitting empty. A lot of developers are pencils down right now. Cap rates have gone up a little bit, so values have been impacted. Is it all negative? Is it, all bad time right now? Or what are the trends that we're seeing kind of from where we're sitting now, kind of summer of 2024 going forward? Obviously, there's some unknowns with the election, with interest rates, but what are you seeing just with some of those conversations with the manufacturers, with the users of, how are they thinking about making decisions as a business and, growth and those kind of things?
Sure. I mean, there's still a need out there. So the desire is there to expand. The desire is there for more product. And again, it's just trying to be more strategic about that growth, because you have to keep in mind that interest rate increase that affects the guy that's building the building it's probably even more impactful for the guy that's running the company that has a $200 million payroll and has to buy, $500 million worth of product that he has, on hand at any one point in time. So that increase in the rate that they're borrowing at really impacts the amount of product that they can get and how quickly they have to get it out the door. So they, guys that are, making widgets really want to knuckle down and keep a very tight rein on, am I being as efficient as possible with that product? So again, yeah, people want to build it, and there's the desire to grow, but they have to have a compelling story why I need to grow right now, especially with the thought that interest rates may go down in the next 3 months or 6 months or whatever. So, and again, it seems like we do hit pause a lot of times during this election year. It seems like we do have a little bit of slowdown every 4 years. In commercial real estate, just because there's some uncertainty out there in the market. I will tell you this, though. I mean, one of the asset classes that we haven't really talked about is kind of that mid-size, flex space or smaller industrial, building buildings that are somewhere between 15 to 50,000 or maybe even 75,000 square feet, and being willing to demise those to smaller users. That is a 3,000 or 15,000 square foot user. It's hard to build that product and have it pencil today. But if somebody's able to figure that out and build a quality product at a reasonably, fair price, lease rate wise, there is almost an unlimited supply of people that will consider that product. And the vacancy rate in that product has remained extremely low, at least in our markets here. So,
yeah. What have you seen from cap rates right now, right? Obviously, interest rates have gone up. Fastest rate in history. It's put a lot of pressure on cap rates. We've seen transaction volumes just plummet, right? From the amount of deals that were done the year before to now is pretty crazy. So it's hard to get good data, right? Because a lot of people aren't willing to sell because they're saying, hey, the expectation is interest rates will go down at some point and capital will come back, and that will drive down cap rates. So maybe there's a lack of data, but from what you've seen, I mean, cap rates, they've gone up, but not a ton, right? Or what have you seen in the market?
Yeah, it does depend on the asset class. Again, I dabble in retail and some other asset classes, and we've seen some of the smaller retail strip centers. The cap rates have gone up a little bit, but not a tremendous amount. So I think we're seeing a lot of that stuff still trade at numbers just slightly above where they were at during COVID.
What about industrial specifically, though?
Yeah, industrial has slowed down dramatically. I mean, we've seen a 75% decline in investment sales in the last 12 months,
but that's pretty much the same for, I know, multifamily is at least that, and
yes,
I mean, retail, others might not be as much, but it's not abnormal relative to other real estate, right?
Sure, absolutely. I think it's become, from the investment side, I think the product that is traded that has, investment grade tenants in the particular property has continued to trade at a very low cap rate, to the point where it's negative leverage, and people are looking to deploy capital, but they know long term that having that Fortune 200 company in my building with a long-term lease, at some point in time, I'm going to be able to refinance and produce a better return for myself. So they're still willing to take a gamble on a pretty sure tenant with a lower cap rate. Some of the smaller industrial or flex product has gone up to some degree, but if it's good product in a good location and the fundamentals are still there, we're still seeing those trade at maybe 100 basis points, maybe 50 basis points over where they were at 12 to 18 months ago. But those numbers have still held pretty strong over the last 12 months. So there is a desire, and I think there's a lot of capital waiting to go out there and acquire more assets. But again, like you said, if you sell it, if you own a good asset and you sell it, where are you going to go place your capital?
Right.
Yeah. I mean, that's what a lot of guys are asking themselves, Totally. So I've got something good. Why would I go try to do something else with my with my cash right now? So.
Right. What are the expectations kind of on a go forward basis of, I mean, obviously you don't have a crystal ball and, no one knows the future, but what's kind of the market, expectation on where do we go from here, from investment sales, from transactions again, from will there be another development boom, or we kind of things on hold right now?
Yeah. I think most guys, would say that, when we start seeing some rate reductions by the Fed, they're going to slowly start getting back into the market, building more product. And I think we'll start to see deal flow on the investment side pick up when that happens too. Because when guys are investing more, they need more capital in, so they're going to sell existing assets so they can keep the machine moving. So I think from a crystal ball perspective, it depends on how quickly rates drop. And I think the election plays a lot into that. Obviously the economy, what happens with unemployment rates, inflation, that's all going to factor into it. But I would say that we're not going to have a boom like we did with during COVID, but I think it's going to be slow, steady growth, which is probably more healthy for the economy anyway. So, I think 2025 is going to be a good rebound year, but it's not going to be double what we did in 24.
Right. Yeah. So that makes sense. Let's chat a little bit about development of industrial. Right. This is, for a lot of people that may be newer to industrial and then even newer to development investing, right? It can be a little scary because it feels like you're taking a lot of risks, right? You have, construction risk, you have interest rate risk, you have tenancy risk and other things. But one of the cool things that I think is so unique about this asset class as compared to other real estate is you can build these, like you said, they're pretty templated a lot of times. I guess it's a big box, right? And you're doing it with aluminum siding, you're doing concrete siding, and maybe there's a few different things you change here or there, but it's not rocket science. As long as you have a good location, it's really determining, what will the potential primary use be, but you can even build an empty shell without having to know who the end user is going to be, right? And that's the cool thing a lot of times is you can build it to where it can actually fit both a distributor use and or a manufacturer use or some combination thereof without having to spend a whole lot more on the front end and taking that risk. And so you can eliminate a lot of risks. You can many times get gross max contracts from the construction parties to where they're locking in their costs. What your actual hard costs are going to be. And from my perspective, looking at lots of different investments, lots of different asset classes, the kind of golden metric is, in my opinion, is yield on cost, right? What's the kind of net yield that we can generate on an asset with all the costs in, right? It's kind of the great normalizer from a development standpoint, as well as, value add and other things. But looking at, how much yield will this project generate relative to other asset classes with a similar risk type? And industrial, from my perspective, at least the deals we're looking at, right, are much, much higher than multifamily from really any other development focused real estate that I've seen. And if you're active in the market, you have a pretty good sense of what these numbers are going to be, right? You know what your construction is going to be. We're seeing active leases, happening right now. So we have a pretty good sense of what the lease rate is. And, the expectation is there's likely going to be future growth, and you can actually build some of that growth into your rental agreements. And so you have this kind of max flexibility. And so you are taking some risk, but you can eliminate or at least reduce a lot of these risks and potentially step in at a good time where, there's not a whole lot of competition. Talk about your perspective of seeing some of these developments go full cycle and, how do you lose in these situations and, when do you win in these situations?
Sure. Well, this is where I think multifamily and industrial vary pretty significantly.
Yeah.
So, the risk is you build a big building, you put it in a good location, and then you don't fill it up with a tenant right away.
Yeah.
And how long is that hold period? I think if you build a good asset in a good location with the right amenities, it's not a matter of if, it's just a matter of when you're going to fill that product.
And sometimes it can feel challenging because in multifamily, you're leasing, unit by unit. So you see it start ticking up, but it's really binary many times in these industrial big buildings where it's one lease or no leases. And so it can feel like you're taking a lot longer.
Feast or famine. That's correct. And you're right. Cause that multifamily, a failure in multifamily is if you get to 60% and you just can't get 100% occupancy. Yeah. And it takes longer than you expected. But when you sit on an industrial building for 12 months or 18 months and you don't have a tenant in there, it becomes nerve wracking. So big risk, big reward. That's why it takes a special group to go and build and develop this type of product. Because, there is risk involved with it. But, if you plan for some potential vacancy and know that, it may be a longer road to hoe, then you can make some great returns in this. So that's why the returns are so good in this industrial product, because it takes a lot of cash, one, and it takes some risk in order to make this work. So from a development standpoint too, construction costs have gone up dramatically. Since when we first started doing some stuff down in Wichita, even prior to you doing stuff down there. I mean, the cost of construction has gone up pretty significantly. But, I just looked and saw that rental rates in our market, kind of here in the Midwest, have gone up about 31% over the last 5 years. That's a tremendous testament to how valuable this market is, how strategic it is, and why it makes sense to do this type of development. So, construction cost has gone up, but there is a real user out there willing to pay what it costs to build this product. And frankly, we're extremely cheap compared to other markets across the United States. And you throw on top of that, Kansas and Missouri both offer incentives for developers to go out there and take a risk in building product. You can get tax abatement, you can get some sales tax abatement off of raw materials that are used in the construction of the building. So it's very advantageous to build, at least in the, Kansas and Missouri areas, without a doubt. So,
yeah. What are you seeing, just kind of as final thoughts, where the big opportunities are, right? Where do you see, as an investor, you're putting on the investor lens, and, it's difficult to want to go take risks right now because it feels like there's a lot of challenges, right, across the economy, across real estate in general. But many times you have to be a little contrarian to get in at the right point of the cycle, right? To be, fearful when others are greedy when others are fearful. And, from our perspective, we see a lot of opportunity in other asset classes, but industrial is far and away the number one real estate for us asset class from where we think opportunity is, because of the yields you can generate on your costs and the long-term drivers that are going to be continuing to create demand for this kind of fundamental shift in the American economy. But getting a little more micro, where are you seeing? You kind of mentioned southern markets, Midwest markets, smaller spaces, right?
Mm-hmm.
And the ability to demise, which another kind of cool thing with development is you can go build a larger building, but then you can go and demise it down into smaller sections of a building and lease those out. And so you can de-risk some of the, all or nothing kind of lease risk a little bit. But where is the opportunity that you're kind of seeing?
Well, from a product type, I think there's going to be some opportunity to buy existing assets that have some upside to them, some built-in upside, maybe with rental increases for existing product here over the next 12 to 18 months. Because I think you're going to see some developers that say, all right, I've held on to it long enough. My cost of capital is high enough. I'm ready to dispose of those. So I think if you have cash,
take a little discount to what I got a couple of years ago, but hey, I'm still going to make money and I got some maturing debt, or I've got other things I got to do. I'm willing to.
I've already been clipping the coupon for 2 years. They paid me rent enough, so I've adjusted my basis down. I'm going to go ahead and move on to the next one. And they realize that they can build a new product and probably, create a better return than sitting on that existing asset. So I think we're going to see that. So there is going to be some opportunity for guys with dry powder to go out and make a deal. The other thing I would say is, I think in some of the mid-sized markets, I think the stuff we've done down in Wichita is overlooked by some of the larger developers. I think that's a great opportunity to go build in a market like that. And not all are created equal. You need to have great highway systems.
Yep.
Decent rail access is not a bad thing to have in a market.
Workforce, you mentioned.
Good workforce is really important. But if you can check those boxes when you find a mid-sized market, I think there's a great opportunity to go build in a lot of those, because the workforce is there and they're not already sucked up by a lot of other, giant buildings or corporations that have already located to those areas. So
right.
I think that's a good place to focus. I looked, so Dallas, Phoenix, Savannah, the Greenville, Spartanburg area, and San Antonio have the most available new inventory based upon historical absorption that they've had within those markets. So, Dallas is a monster market with a ton of new product that's been built. I think there's an opportunity to go build there, but I don't know how you differentiate yourself when somebody's looking at 25 different buildings that all could meet their needs that are somewhere between 100 to 250,000 square feet. it's a little ominous to go into a market
it's
like
very
that.
market specific of where the opportunity can be.
Absolutely. Like maybe you say Colorado Springs is where I want to be next, or something like that checks the box for having a decent sized population, decent highway access, and maybe even if it's got a high barrier to entry. Mm-hmm. Some of those markets, I've dabbled around in Salt Lake a little bit, where the cost of ground is extremely high and there's limited opportunities to develop. Those are great markets to look in at as well. So, and that's true in a lot of those states that fall along the Great Divide. Colorado, Idaho, Utah, Arizona, New Mexico. Those are all good markets to really give some serious consideration to as well, I think. So,
yeah, that's awesome. Well, Brent, this has been super helpful. Any other final parting thoughts or?
It's fun to talk. It's hard to believe that we can spend an hour and it feels like 10 minutes. But yeah, industrial real estate's great. It's fun to be involved with it, and glad we're partnering together on it. So
awesome. Well, thanks for coming on. This is always fun to do in person, and get to have you on and share the updates. So hopefully you guys all got value out of this. Definitely want to encourage you to get on the mailing list if you're not already. Stay tuned. We do have some exciting opportunities kind of coming down the pike that we think are really well poised for this current economic environment. And with that, Brent, thanks so much for coming on.
Appreciate it. Thanks a lot.
Hey, everybody. Thanks for joining our Masterclass in Industrial. So a lot of big things we talked about today. Really glad that Brent could share with us. And like we mentioned, we've got some exciting opportunities coming down the pike. We believe that industrial is one of the key asset classes that's going to outperform over the next several years due to a lot of the supply and demand factors going on, and really compared to other asset classes in real estate, to us seems to be kind of the golden goose here. So a lot of things that we're excited about. Specifically, we've got a lot of projects in the Midwest, but right now want to take a few minutes to do some live Q&A. So if you guys, have questions, love all the comments we're seeing here in the chat right now, please put them in right now. I'm going to send the next, 10, 15 minutes for any questions that are going to be asked here. See Brent, is he on LinkedIn? Yes, he is. Brent Peterson. He's with NAI Heartland. You can reach out to him there. Sam, I don't know if you could even, find his contact and put it there. But any questions? So, we have, he talked about obviously one of the projects we have in Wichita here in the Midwest. We've got some other deals that are going to be happening here in Midwest markets. It's a big story that is, really happened kind of post-COVID that we saw, with the landscape of industrial really starting to shift for the manufacturing companies. I actually just saw this chart 2 days ago, if you want to pull it up, Sam, which I think is pretty fascinating. You can see here, this is U.S. factories under construction. So this is basically the construction spending for factories in the U.S. on a rolling 12-month basis. And over the past 3 years, it has tripled. So these are large companies that are looking at, like, say, chip manufacturing, for example. There's another example in Kansas City. Panasonic is building a huge battery facility. It's going to be a multi-billion-dollar project that they're underway on right now. And so we're seeing this being a consistent theme where companies are deciding, hey, we need to reconfigure our supply chains. We need to bring manufacturing back to the U.S. And for a lot of reasons. One, it's become way more expensive to produce in China. It's actually costs for labor have increased 15x over the past 15 years. We're seeing shipping costs go through the roof, and not to mention all the political risks that are associated with the supply chains as it's been built. And so a lot of companies are realizing, hey, it's way more important that we have confidence in being able to deliver products when we want and not be reliant on other countries, other issues with the supply chain to meet those demands from our customers. And so this is really, we think, the beginning of a fundamental shift in how companies are building their supply chains, or they're building their manufacturing facilities and the distribution networks. We're actually seeing a huge increase in job announcements. So it's been up 66% over the past 2 years. So you can see these is from the reshoring initiative, a huge increase in jobs in the U.S. related to manufacturing. This is really interesting too. This is kind of a consistent theme where, we kind of take for granted in the U.S. that we are an energy powerhouse, energy producing powerhouse that a lot of countries don't have the luxury of, right? We produce our own oil, we produce our own natural gas. And for a lot of manufacturing, energy is one of the biggest line items on your operating expenses, right? And so a lot of these companies that are overseas based or headquarters in Europe or other places where they don't have energy independence like the U.S. does, it is a huge factor in determining where do we want to actually build and commit to having secure and confidence in our energy costs. And so it's pushing a lot of manufacturers to the U.S. BlackRock just, earlier this year came out with their 2024 private markets outlook and identified logistics hubs. So manufacturing and industrial hubs that are located in, close to great distribution networks or highways or interstates as a one area that they think of 3 in the U.S. that's going to outperform other asset classes. And so, again, a lot of exciting things related to this industrial asset class. I don't have the data right in front of me, but by most estimates, from estimated values and cap rates, industrial is probably the only commercial real estate asset class, or I should say the leading commercial real estate asset class from a value standpoint since interest rates have gone up. So it's seen very little compression of values and expansion of cap rates to where it's only a little bit off the highs that it was a couple of years ago, but expected to come back as absorption and cap rates kind of continue to normalize and interest rates come down. So do we have a pro forma for the investment class? We do. We're actually going to be launching a new deal in the Wichita market. That's really a rinse and repeat of a deal that we just completed and had great success on. Actually returning capital to investors ahead of schedule and even in this environment. So we'll be sending out some details on that in a few weeks. We have, you want to pull up the QR code here, Sam. You can click on or take a picture of this QR code. It'll take you straight to our interested form. You can get on the list to get early access to it if you'd like. We'll be sending out the details, I believe, in 2 weeks from today. So we're getting ready to put all that out there. But yeah, right now in a development, we're targeting 20% plus IRRs. And the great thing about industrial, one of the reasons we love the asset class, aside from the economic fundamentals around the asset class, are the timeframes, right? If you're going and building multifamily, multifamily development, you're usually going to be 2 to 3 years of just building construction, and then another probably year or two to lease up the property, depending on the size. In industrial, you can usually go from, going from horizontal work, getting the ground level, to vertical completed project with less than 12 months. And so it's a much shorter time period, and the leasing activity is still very strong. You can have those conversations before you even completed, so that you can kind of recycle the capital very quickly. And so that's what we're doing in our pipeline that we've been building. Any other questions here as we kind of finish out the Q&A here? You can just go ahead and put them in the chat. If not, then feel free to take a picture of the QR code here. It'll take you to a form where you can get on our list for early access to our investment deals coming up real soon. All right. With that, thank you all so much. Hope you got some good information from our masterclass. And like I said, Brent's one of our partners in this asset class, wealth of knowledge, very respected in this industry, and glad that he could share with us some of the gold nuggets from what he's seen. So with that, be sure to stay tuned. We'll be sending out more communications on our next industrial deal here very soon. And hope you have a great rest of your day.